All right. Good morning, everybody. Tuesday. You know what? Looking at that weekly range yesterday and the quote, hurry up scenario that it implies on the week that we would be stagnant and stalled while we wait on something looks to continue today, all things considered. We don't really have a lot on the table. These hurry up and wait scenarios, I like them better when I have a really big known event, FOMC being a really obvious one, right? It's so simple and easy when it's something really drastic and big like that. But we don't have anything that big and that obvious this week. So it leaves us wondering, picking and choosing, trying to find the one that is going to be the cause of this stress and worry that the market's presenting. We're holding our own this morning with China basically flat, the Dow also flat, a little bit of juice in the S&P and then the Nasdaq, and small caps are outperforming this morning at 0.5%. You know, we've seen this a lot this year where small caps would carry the load in the overnight, and then we would get back into the regular trading session and they would kind of fall out and others would take their spot. Someone just said that it's storming in Jamaica. Well, I'll trade your storm for my snow if you would like. Jamaica sounds really good right now compared to all this snow. So keep your eye on the small caps. See if they continue to dominate through the morning or not. They are a little bit of a tell all by themselves. Seeing them run like this just shows that they're really looking for the not so crowded trade at this point. Lots of things that we can look at when we start to consider small caps. There's the idea that maybe they're trying to diversify a little bit, get out of the crowded trade. Then there's the left for dead things. Um, there's the idea that if a lot of stuff was short, maybe they're buying it back, right? So by itself, just seeing small caps up doesn't really give us any actionable intel. We want to really dig into the why behind it, what's going on, and what areas. Small caps, there was a lot of those miners and junior miners that did really good this year, and those are low float penny stock trash companies that really started getting woken up this year. And then, of course, AI helped out some dead biopharma companies and other medical companies, insurance, things like that. So there's a why behind most of the stuff we see. We just got to dig it out. There's some ETFs that you can use with small caps just to as a tell, right? We don't want to trade the ETFs, but IPO is a good ETF to use if you want to monitor the small cap space. And I got a couple others. So we'll dig through them later. You can see we really don't have a lot on the table today. Big picture. The auto sales, not really. So Feds chipping their teeth. What are they going to say at this point, right? I mean, they've said everything they're going to say. They've whiplashed us from, hey, we're going to cut. No, wait, no, we're not going to cut. Hey, no, we're going to cut. The market's been a roller coaster for the last 6 weeks. So, we're close enough now that if they try the whole, hey, we're not going to cut again, I don't think the market's going to bite. I don't show this often enough, but if you ever hear somebody talking about, oh yeah, I was priced in, and you want to know, well, how do they know it was priced in? How do they know that Fed cut was getting unwound or a Fed cut was getting priced in? I use this site. I'm sure there's others. I think Bar Charts has something like this too. There's all sorts of Fed watch sites out there just monitoring what the Fed is implying and what the trades are indicating, because these are all trades that are moving this needle higher and lower. But we can see the December 10 FOMC meeting and the likelihood of a rate cut right here. And this went from the 90s, a 90% chance of a cut, down to the 20s, a 20% chance of a cut, back up into the 80s in the last 6 weeks. It has been one heck of a ride. And this has been a part of the uncertainty in the market, the whiplash between, hey, we're bullish. No, wait, maybe we're not. Hey, oh, yeah, I guess we are. And we're in this regime where the Fed is not providing a fait accompli when it comes to what they're doing with interest rates. In different years and different cycles, they'll tell us in advance, yeah, we're going to cut, 2 points over the next 4 meetings or 8 meetings. And so every meeting, we're going to do a 25% basis point cut, and we're going to keep cutting until we've shaved off 2 full points. Well, that's great. Then for the next 8 meetings, we're just going to get these quarter point reductions and we're on like autopilot. And the market behaves in a completely different condition when it has those sort of forward guidance. We're not in that. Instead, we're in this wait and see mode where the market has to try to read between the lines and shake the magic 8 ball to figure out, hey, are they going to cut or are they not going to cut? We're reading between the lines on everything that every single Fed speaker has to say, and we're looking at the data to try to figure out, is bad news good news, or is bad news bad news, or what are we going to do with this? Are we really going to cut? Maybe we're not going to cut. It didn't help when the government shut down and then we didn't have any data at all, and we really couldn't read between the lines. There was no lines to read between. So it's been a rough 6 weeks, and we still don't have that forward guidance. We need to get to the meeting and see what they have to say, which is, very likely going to be a cut. But then what? Are they going to suddenly put us on autopilot now? Probably not. We're still in a really delicate situation, and they're going to continue to say, oh, we need to read the data and make decisions as it comes at us, and we'll let you know when we get to the next meeting what we're going to do. And we're still not going to have forward guidance. And that makes it a lot harder to try to position your longer term accounts. So this is called cmegroup.com FedWatch. If you just Google FedWatch, you'll find it. It's pretty easy. It's free. It doesn't cost you anything. You don't need to sign up or buy anything. It's just a really great place to be able to see what the projections are for the next rate cut and the next FOMC meeting. There was a comment about Trump having something this afternoon, and then I lost sight of it. I know I seen that headline somewhere. Market isn't picking it up at this point. Oh, they did find it. Okay. When I was looking here earlier, it had not shown up. So we got a little bit of a risk probability coming in because there's a cabinet meeting and an unspecified announcement sometime today. The cabinet meeting is at 11:30, and it says 2 o'clock in the Roosevelt room. He'll make an announcement. Hey, when it says the president's going to be blah, blah, blah at a certain time, not just this president, but all presidents. And sometimes we're waiting around for 2 hours, 2.5 hours, and then sometimes it comes in early. So this isn't like one of those economic schedules where it's going to happen right at 8:30. This could be early. It could come in, anytime, say past 1 o'clock, or it could come in late all the way up to 4 o'clock and then some. So it says 2. Consider that a rough estimate, and we'll play it by ear. Keep your eye on the news through the day too to see if they sharpen this or really dial down and confirm it to be 2 o'clock. This is the 10-year for Japan, the JGB, as you can see, Japan government bond, JGB 10-year. And it is extreme parabolic. You see that really beautiful rising wedge with a blow off top scenario? The only thing that makes me a little nervous about this particular rising wedge is my old argument about how a uh, a wedge should play out. So I'm just going to draw this somewhere. It doesn't really matter where, just anywhere. So when you have a wedge, you really don't want to get into the last little bit of that wedge. Percentage wise, I'd say it's the last 20% or so. I've seen it as much as 15, but 20 is really the key. So if we were to sort of consider this area, we don't want price to get into this last little bit, right? If it happens, and it doesn't have to be a rising wedge like this, it can be a falling wedge, it can be asymmetrical wedge, you know, the one that's the same on all sides. If you get into that last little bit, it seems to break the pattern, and then we don't get the follow through that we normally would expect. That's been my experience. So once you reach this kind of point of no return, you don't want to see price continue to work in that range. Then when you have a wedge like this and you get that blow off, this is supposed to fall because that's what rising wedges do, right? They're supposed to fall. But before we fall, there are times where we get this sort of blow off top first. So from this point right here, this is what we're supposed to do. Just kind of make our way to the downside. And we would measure this and project that from the breakout point to try to figure out how far it's going to fall. But sometimes we get this sort of blow off top scenario first, the last hurrah, right? So we rip to the upside equal to this distance, and then we roll over. So it's that big fish move that I like to draw, right? Somebody told me that was the fish symbol. I didn't know that. So why talk about all this? Well, on the ES, we've had some really nice rising wedges in the last few days, so I thought it was worth mentioning. But also, we've got it here on the JGB 10-year, and we got into that 20% area that I don't like to get into. And what I have found over the years is if we get into that last little bit, that 20%, we don't get that follow through that we typically would expect to get. In this case, we blew off the top. Okay, that seems to support the idea that we're getting our blow off top. We're going to roll over, cut back down through the wedge, and drop somewhere into 1.4 or 1.35, something like that. Except we got into that last 20%, and I'm not so confident that we're going to manage to get down into 1.4 or 1.35. I think it's possible that we drop back down into 1.6, 1.65-ish, and we hold the line there. And that's if we even get that much, which would be like a Busby off the top of this range breakout. So it's worth keeping your eye on for sure. They're raising rates while we're cutting rates. And there's this complete unwind of the entire system that we've been running for a couple of decades, at least a decade plus. And we really don't know what the outcome is going to be to all of these changes and what may break along the way. Because it's crazy complex stuff. And the people that are supposed to, quote, know what they're doing, a lot of them only know to push button A when told and to push button B when told. They don't understand the nuances of their own job. They're just some fool who was taught to do one tiny little piece of that job, and that's it. And they don't bother asking how their role fits into the bigger picture. So what happens when it breaks? Above 6,800, the overall bullish liquidity picture is intact. That would be this image here. So we just need to stay above 6,800. And this is for the SPX, not the ES. Communications equipment, semis, and semiconductor equipment were the most bought in November. And information technology was the most sold, or was net sold, not most sold. Let me rephrase that. Most sold for the first time in 4 months. So it's still tech, right? But it's nuanced on which tech. That kind of argues that the AI trade is still alive and well. All right, the put wall rolled down and the call wall rolled up. When you put that out on a daily chart, which is what I have here on the right, you can see that the call wall is completely outside of this range. That range that we've been working on for quite a while, right? We'll just back it out here. So the markets are pricing in or getting out of the way of a move all the way back up to this high. I'm not saying that we're going back up to that high. I'm saying they got the call wall rolled out of the way so that the market could go back up to those highs, right? Big difference in those two statements. So they removed roadblocks to make it easier for a run back up to the previous high, and we could overshoot into 70.11 cog line. But they did the same thing to the put wall. They got the put wall completely outside of that range and kind of removed any obstacles for a move down to 65.11 cog line. Don't you love how those cog lines just keep coming into play? Couldn't make that up if we wanted to. So we are above the volatility trigger and we are in positive gamma. In positive gamma, when we try to break out each day, we expect dealers to sell into that breakout, right? Because that's what they do in positive gamma conditions. They sell into strength and they buy into weakness. The idea being that we get small daily moves, that our average daily range begins to contract. We don't get as many of these big violent bars that we normally would see in a bearish market condition, and that things just slow down a little bit. Volatility decays, the daily moves get smaller, and we get a cleaner, more precise day-to-day picture. If we break back below the zero gamma, then we would expect that regime to change and they would sell into selling and buy into buying. But we're not there. So that flip point is around 67.32 cog line. $61,000 on the overnight volume. It's a little lighter than yesterday, but it's still above our 50 plus zone. So It's good, healthy, decent volume, maybe even a little bit of a surprise in the volume, given that this is supposed to be a hurry up and wait week, and we're getting into that last month, the holiday thing. We're going to see more and we're going to see less and less participation. It doesn't make sense to say more or less volume, right? So we're going to see less and less participation. I'll act like I speak English once in a while. Here's the ADRs for the day. Like yesterday, we don't really have an expectation that we're going to leave the ADR today because we're still in the hurry up and wait mode. We knew that that was the mode yesterday because that's what we saw on the weekly expected move, and we're waiting on something. We don't really know what that something is because it's not one of the big obvious ones like non-farm payrolls, FOMC, CPI, PPI, one of those. But market's waiting on something because we could see it. It's not today. There's no hedging or no additional hedging. To hit either ADR line today, we would need an inside day breakout. And while it's technically possible for us to break out and run, because, well, we haven't done it for a little while, and the longer we stay sideways, the more energy we build up. I don't know that today's going to be the day, right? So one thing about a market that's sitting in a range is the idea that we're just coiling and coiling and coiling and coiling and coiling, and we could break out. Markets are a lot like nature in the idea that if you compress energy in nature and you don't release some of that energy, it'll just explode like a pressure cooker. Even something as simple as a dam lets water out because you have to release some of this energy at some point. So if we stay tightly coiled in this range, we're just going to keep winding it up like a battery on a charger with no stop limit. It's just more and more and more and more and more, and finally it's going to pop. But while we're sitting on that charger building it up, nobody knows if they're right or wrong. So if you're short and you're in this range, you wouldn't know until we break to the upside that your short was wrong. Same thing if you're long and you're in this range, you wouldn't know you were wrong until we broke that low. So as long as we're in this range, both sides can think they're right and they can keep adding to the position. More and more people can get in because we still don't have any definition of who's wrong. And what happens is we get all these stops up here and down here, and we start developing this bumper car system where it's going to get harder and harder to break out, and we're going to need a bigger and bigger force to make that breakout happen, higher or lower. So the sooner we GTFO and get out of this range, the better. Will it be today? I mean, it shouldn't be, because today's not the day that we're waiting on. We're waiting on something later this week. So if we break out today, it's very likely that we just come back inside the range. I would start with yesterday's RTH range. That's what I'm marking out here, because it's the smaller range. So if we break yesterday's RTH high, we got the 111 and the 1236. And of course, if we break that low, is that now working? Try a different button. If we break the low, then we've got the 111 and the 1236 on that side. Once those are exceeded, you have the full day's range to break out and test. The easiest way to do that is just to go out to a daily chart and look at what the broker said was yesterday's high and yesterday's low. And there you have it. So there's the real mid 68.32 cog line. And if we get outside of the RTH session, then this is the high and the low that we need to get out of for a real inside day breakout of yesterday's range. Start with our own Globex range. That's the box you have to get out of. to test yesterday's high and yesterday's low. Once we get outside of that, then we have all of yesterday's high and all of yesterday's low. And as you can see, that lines us up with Friday's high of last week, or Sunday's high. I guess it's close enough. And the Sunday night, Monday low. GTFO, we got to get out of this box. The fact that we're back above the 50% is a really good start. You can see how we checked that level here before we fell lower, and now we've made another run at it. The low stopped on the RTH low of yesterday. That's why those levels are so valuable, right? At least they're valuable to me because that's the way I trade. 68.11 cog line, reversal off the low. We checked against that midpoint, wasn't able to get through it, but now we have, and we're on the top side of it. We want to keep that. We don't want to get back below this half. And I'm thinking that we're likely going to do it anyways, and we're just going to sit in this zone and chop around all day because we're in hurry up and wait mode. And until that changes, we shouldn't have any expectation that we're going to break out and run or go do anything. GTFO, we got to get out of the box. Today's floor pivot is lower than yesterday. That's bearish. Price opened underneath it, and that is also bearish. We've gotten above it. So that's a little bit of a positive at that point, but we were headed up to it anyways because we were supposed to hit it. Markets want to hit their pivot. It's generally what they do. Put that on a higher time frame. So here's the floor pivot, R1, S1. We were fading down, but we never got to S1, and now we're on our way up, and so far we haven't made it to R1. The R1 and S1 are very much like the ADR halves. We can stay inside of that zone or range and just bebop around like a pinball without ever really accomplishing anything. And so far, that's what we've got. We really don't have an expectation that that's going to change, at least not yet. You know, the 10 years very likely continuing to go up because the expectation of a Fed rate cut. So if you're seeing that the 10-year making a decent move yesterday and it's doing it again this morning, what, 4.1, 4.15, 4.2, all on the idea that we're going to get a Fed rate cut. That's one of the tells that we're going to get the cut, right? So the SNR pretty much validates our ADRs at this point. No real reason to think that we're going to get an R1 for an S2 or an S1 for an R2 today. We will be lucky to hit either side and break beyond it. But as I've said before, if we close above R1, we'll aim for R2. If we close below S1, we'll aim for S2. We're building out last week's high volume node. It's a little wider and it's a really clean distribution so far this week, but that's all it is just a really clean distribution this week. If you look at what we got, it's a nice bell curve example, but it's just enhancing last week's zone, right? So we're just continuing what we were working on last week. If we break this Globex low or yesterday's low, then it's shallow. We should move right on down through 6750 and get into that 6720 high volume node down here. It's the point of control of last week. There is one speed bump around 74. I don't know that it's going to be enough to make a difference, but maybe they got a loose tailpipe or something. Who knows? I think 20 is a more realistic pause point than 74, but it's hard to see that and not want to be curious about what happens if we get there. $10-day, 30-minute volume profile and TPO. The TPO and the volume profile are aligned on their point of control. I mean, almost dead on perfect. The value area is a little wide, but still, this is as close as they've been in a while. Usually recently they seems to have just a lot of discrepancies between the two. The TPO looks much cleaner still, with very distinct high volume nodes at the high and the low, and then these little smaller distributions that really don't highlight all that much. They do seem to line up with SWOT gamma's levels, but that's not going to be very helpful. We're continuing to build out this range. If we stay here through the day today, I would not be surprised to find the point of control up there tomorrow for a number of reasons. By tomorrow, we should start to take these candles out on the left, right? We're going to take these candles out through the day today, and into tomorrow, we're going to start to get these candles right there. And that's the key to moving this thing up here. Also, we're sitting in one spot and we're building out that range. So we're putting in more work here, building these out at the same time that we're losing these candles. And so by default, we're going to see that come up. The trick, I guess, would be what's going to happen first. Are we going to put enough volume in to bring it up on our own? Or are we going to lose the volume down here and just by default see it moved up to us? It doesn't really matter, I suppose, one way or the other. Just the idea that it's very likely going to be up here when it's done. And that'll make for a nice springboard. I guess the best way to think about this is, if you're in the pool and you can push off of the wall, then you can really launch yourself forward and get moving through that water. But if you're just sitting there floating and you decide you want to start swimming swiftly towards the edge, you don't really have anything to launch yourself from. So if we're looking for a move higher, it would be better if we were doing that from a secure area to launch from. And having that point of control up here would really help accomplish that. That way we could push into 6950, 7050, something like that. I'm already hearing a lot of talk about seasonality and how December is supposed to be a bullish month and blah, blah, blah. Be careful with those sort of off the hip look back. Seasonality is only as good as the data. And just for context, if you look back at a December candle over the last 15, 20 years, and you're only looking at how it closed, sure, it may have closed green. But what did the candle look like? Right? Was it a candle with a real long, deep stem? Say a little bit of a body and a really long, deep stem? Because if that was how the December closed and we say, yeah, it closed way up here, it was a bullish December. Yeah, but you had all that heat first before it turned around and it made it back up and got to that level. So seasonality can be a little misleading if we, look back and say Decembers are usually pretty bullish or that they usually close bullish. It's a lot of room in the middle there for it to move around, including down. But I still like 6950, 7050, 7150. We don't have a new VPOC from yesterday because we're just working our way through. Got a nice distribution forming across the top up here. We ran into a bunch of sellers. So we're going to see how we can build this out. And if we can, then let's get through it and try to challenge these other two peaks, Monday's high and Friday's high. I'm really not looking for Europe to provide any insight today, right? Like there are times where we really want to pay attention to Europe's close. I'm not seeing it today. No, but it's worth asking. All right, the weekly expected move. We are near Friday's close, but we're still underneath it. So on the week, the hamster in the wheel, we haven't done anything, right? We haven't done anything. So we're not even back to where we started, but we haven't gone anywhere. Hurry up and wait mode is firmly in effect. 7,500 for 2026. Yeah, JP Morgan's getting a little ahead of themselves. It sounds like they're just trying to sell their book. I think 8,000 is a big stretch. I mean, come on. But I mean, check out what Yardini has been saying, right? Yardini's been bullish since 2020. When we were coming out of the COVID lows in April of 2020, Yardini was talking way back then that we were going to 7,000, 9,000, 8,100, and that this was, quote, the roaring 20s all over again. Yeah, he's prolific, man. Bloomberg, Macro Me, he's all over the place. Stockcharts.com. I don't know if that guy is a trader or, if he's just making money on his appearances because he is all over the place. All right, so we are still above the 10-week, nice and easy. We're a little off from the high that we set at that 2%, but the continued decline is very evident. We still are looking to see a break or a change of this venue, and we don't have it yet. So we're fine. There's nothing wrong with our situation here. We're above the 10-week, and that's solid. We're looking for a good reset, and we just haven't had it yet. 1-day decline doesn't really count for much. We're back above the fold, and we're still in this falling regime, and that's just where we're at the moment. So that needs to change, and it hasn't. But we're not overbought. We're not overextended. We haven't moved too far too fast, and it doesn't owe us any sort of mean reversion, pullback, or least squared methods. And that's what I use this for. Yeah, you could use Z-score, but Z-score can get complicated. The math, gets you scratching your head. And this is just very simple mathematics, right? This is just SMA averaging of price and its distance from the 10. So at least I understand it. Ish. Looking at our distance from the 10-day, we're above that 0.5% mark that I tend to keep my eye on, but we're still under the 1% mark. So even looking at the 10-day, we're not overbought, we're not overextended, we haven't moved too far too fast, and it doesn't owe us any sort of pullback or mean reversion. We still got tech a little bit weak on the momentum side, but otherwise, we're bringing things around, right? And there's a lot of tech, right? When we just say tech, that's really generic. Cloud computing, even healthcare tech, biotech. There's all kinds of tech. So, we want to get more specific when we talk about tech. IGV is like expanded tech. Then there's old tech, new tech. How many times we can say tech? Be a drinking game. Let's see. China's down. Gold and gold miners are down. China again. And then nat gas. But I mean, nobody cares. I don't care. Nat gas. Flip it around. See what's up. Bitcoin is up. ARC kind of goes in with the Mag 7 up. Volume is up. Chips. Robots. Uranium. Tech. Quantum. Mag 7. Some of these, like the Mag 7 and solar here, they're not up enough but being up is a good start. We want to see that follow through. Even if we get it, though, there's no real expectation of a breakout follow through day, right? We're supposed to be in hurry up and wait mode. That would be those orange lines we have here, like yesterday's high, yesterday's low, and VWAP. Very likely we play some sort of reciprocation trade today. Reciprocation is very much like what we had yesterday. We were that far above, we went that far below. Reciprocation, right? And then finally we break reciprocation. You can measure those distances and plot them forward. Well, this morning we've got this distance. So if and when we decide to come back to VWAP, then we'll get that distance on the other side. Then we can measure that distance. If we break that, then we would use that distance as the plot measure for higher and lower, but we have to do it first, right? Inside day breakout would be a good start. The orange line that we're seeing here, though, is all of yesterday. And as I mentioned earlier, if we break this Globex high, then we want to focus on yesterday's RTH high. That's 68.50, by the way, big options level. So yesterday's high, 68.55. It's just a few more points. I mean, what's a few points among friends, huh? And yesterday's RTH low is really close to our Globex low. Ah, that's not even the RTH. There we go. That was yesterday's first 5-minute low. 68.11 cog line. So it's GTFO, right? We got to get out of the box if we're going to have a really good trading day. You can kind of see that rising wedge now, right? Hopefully you can see it. We didn't even get a blow off top yesterday. It just got into that rising wedge and then down we went right back to VWAP. Really nice trade. And when we started breaking down, you should have easily been able to answer that question. Where are we going? To VWAP. Because that's what we do. So that's what we got, guys. Keep your eye on the clock. Headlines, right? We don't really have anything really big today. So market breadth, tick trend, AD, UVol, advanced decline. You could look at yields, but they're moving around with the rate cut, so not really expecting much out of that. Keep your eye on Japan. That JGB 10-year is really helpful. But even that, you know, yesterday afternoon when we started this breakdown, we went looking like, what was that, you know? And there wasn't some big red headline all over finance juice splashing out why we were getting that breakdown. So, you know, we can see some shenanigans while we're in this hurry up and wait mode because markets get bored. Sounds silly, you know, grown adults getting bored and going in and getting reactionary with their money, but it happens. So get out of the box. If we don't get out of the box, then the orange lines are very likely today's range. And if we challenge those orange lines, I'll be looking for a 111 or a 1236 reversal to come right back in the box because we're not supposed to leave the box yet. We're in hurry up and wait mode. If we do leave the box and we get beyond the 1236, then I'm wrong and I will close that out, flip it over and take the breakout. Whatever, right? Everybody, be careful, be safe, have a good day. I'll see y'all tomorrow.